aspects of global finance. Flows, funds, and forces shape the markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates and risk and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
This is a story about being fit for purpose. As the IMF met in Washington last week, its mission of providing global financial stability has never been more important. But one of the fund's key participants expressed doubts about whether it's up to it, whether it is still fit for its very important purpose.
I think we need to step back and look at the IMF and World Bank, their core missions. We cannot have these kind of beliefs getting in the way.
An awesome force of 1,000 players and writers must lead to the front.
That core mission of the IMF and the World Bank was crafted back in 1944 in the White Mountains of Bretton Woods, New Hampshire, less than a month after Allied troops helped turn the tide in World War II by storming the beaches of Normandy. 80 years later, the world is a very different place. And the wars that multilateral organizations like the IMF are contending with are now in places like Iran and Ukraine.
Even if the war ends tomorrow, it will take quite some time for the recovery to begin. War is, in any circumstances, the worst outcome.
There are reasons to really worry about the upside inflation risks of the war in Iran.
The IMF and the World Bank, these were institutions that were created even before the end of the Second World War with the basic idea that if countries can work together and cooperate on the economic and the financial front, and we can have stability in the world, then we would have less wars. Clearly, that is being tested at this current moment.
Until she joined the Harvard Economics faculty last year, Nita Gopinath helped countries work together as the first deputy managing director of the IMF.
In this current environment that we have right now, with the conflict in Iran, the countries that have programs with the IMF, many of them are importers of energy, and they're getting hit by these prices.
Many countries are in trouble right now because of the price spike from the war.
Kevin Gallagher is the director of the Global Development Policy Center at Boston University.
We don't know if this war is going to last. COVID protocol really hit global growth. Is there any time to use that very well? Well, the global economy is very fragile, especially in emerging markets in terms of sensitivity. And this shock is yet another one. That's that. Interest rate hikes just a couple of years ago, climate shock, droughts, and other things in itself. And so even though we're here, the world potential there for the countries around the path of what's going to happen. But yeah, the shock is really setting a lot of things back.
Since the start of the new millennium, we have lived through a global financial crisis, a recession that followed, a pandemic, and several wars. Through it all, the IMF has stayed pretty much the same.
Well, that's one of the changes much that the crisis still offers a family of emergency financing to countries in trouble.
This is a time when it's absolutely critical to give all this. First thing I would want to do is what I is good at is surveillance. That is so about very high uncertainty. Just coming up with a forecast of what the impact is going to be very shocks.
This comes against that broader backdrop of perhaps increasing dispersion in the portion of lives of members of countries through the IMF and their approach to economics. Certainly different from what happened in World War II and IMF. What challenges does that present in the IMF?
Politics, of course, factors before functioning one of these multilateral institutions. I think the IMF is somewhat better placed because it plays a role of a firefighter. And when you're a firefighter, you don't really have the right to pass around. It's not about whether you can have another milkshake or you can give money to a country for a loan that will be available in 10 years. But it's about are you going to bail out country that is otherwise going to be running crisis are only going to affect the country, but it's also going to spill over into the region.
A firefighter like the IMF may not be directly driven by politics or differences in economic approaches, but those politics and differences can sometimes create more fires to fight if they affect the country's fiscal position.
We've suddenly moved away from the time of ever closer integration and an efficiency-driven global trade model to one where national security concerns are becoming important. And I'm not denying that that's not an important one. That certainly is salient in this current world we live in. De-risking supply chains are an important factor. Making sure that you have strategic inputs in your own country. Factories that are in your own countries, those are coming out too. What the IMF cares about is fiscal situation. And if you're going to end up in a world where everybody is going to spend a whole lot more on defense spending, a whole lot more on building semiconductor factories, railroad discoveries, all of that, then you can end up with this big build-up in debt in the world, which already is kind of unsustainable.
It's not just the economic approaches that have changed since Bretton Woods. It's also the relative sizes of some of the economies involved, most notably China, which dramatically rose to become the second strongest economy in the world, something not reflected in the allocation of quotas that effectively determine who has influence over the fund.
The quota has gone up, but not commensurate to the formula that the United States made, which says that it should go up relative to the size of your economy. So given that China is now the second largest economy in the world, they should have the second most voting. But the U.S., in the last iteration of increasing quotas, they said, let's increase quotas, but not without voting power changes, because Japan is number 2, and they both Japan and the United States are trying to reduce quotas. And so I thought a little bit of a legitimacy issue.
Whether it's the U.S. or China or the other major players in the IMF like Spain, Germany, and France, the wealthy countries are the ones that control a fund whose entire purpose is to help poorer countries when they run out of money. And sometimes that has led to conditions on loans that some find unduly onerous.
The fund was supposed to be there to help the countries get a shot in the arm to get back on their feet, but over time, it's had almost the same policy, which is austerity. Now, it's important to have it in countries that are properly set, but so many of the very crises that have been happening in external shocks to countries. These are an inherent structural challenge for the right on the head that countries that receive the programs have no say in what the design looks like. They can request and they often get what they need, but they have no say in the purchase.
But building up sense of occurrence, often structural conditions are required by the situation.
The IMF has evolved as an institution in terms of the policies it recommends and what countries need to do in a crisis, just as in terms of the intellectual property and what helps a country in a crisis. There was a time, and I was in the state of crisis certainly one of those, where there was an excessive focus on just spending cuts, and it was about cutting spending across the board without not to get into details about where the spending cuts would happen. That was a strategy that was appropriately rethought, and now the IMF is really targeting how it's spent. In fact, when it goes in and tells countries to reduce overall spending, it very often says that you need to increase spending to support one open society. Because you are in a crisis, and this is really challenging for them. So far more targeting in terms of what is needed with the spending reductions. I mean, unfortunately, spending reductions are always part of the solution, because that's the only way the country can come back to a more stable macro environment without racking up large amounts of debt. These policies are never easy, they're difficult, but the IMF has evolved over time in terms of making it better tailored to country circumstances.
The world has changed fundamentally since 1944 when the IMF was created. And it appears that one of the largest changes is about to come, with artificial intelligence poised every economy.
One of the things that we talk about all the time now is artificial intelligence and how it's going to transform our world. Typically, we don't know exactly how, but we think it's going to. When you look at specifically what the IMF does and how it may affect different nations differently, how can the IMF sort of anticipate that if it needs to?
AI is hugely transformative, and everybody has to pay attention to it, including the IMF. So even though the IMF has a relatively strong horizon in terms of the kind of problems it deals with, AI is something that they cannot not pay attention to. So they are, in the near term, just looking at where most of the AI development is happening and AI adoption is happening. It is happening in the more advanced world, and I think to China, but everywhere else, it's not as the momentum is not as strong. So at least in the near term, we can see that one of the ways we would have more productive people coming out of the US relative to, say, developed countries. But hopefully over time, when a developer will figure out how to deploy AI or close their skill gap, to the scarcity of doctors and teachers,
Whether it's AI or an emerging China or a breakdown in macroeconomic consensus, Gallagher says it's hard for an IMF fit for its purpose of 1944 to remain so today. And that has led some to call for fundamental reform.
It needs to get bigger, it needs to get better, and it needs to get more inclusive. It's not big enough. The monetary firepower that has only about $400 billion for the poorest countries, and if they all went to the fund like they did during the global financial crisis, we'd be really great. So one just needs to get bigger. Two, it needs to get better. It needs to tailor its programs to country circumstances. If it's an external shock, it should just give short-term liquidity without austerity conditions. And it needs to be more inclusive. The countries that are the biggest recipients need more say in the program design. Those are the three things. Make it bigger, make it better, make it more inclusive.
Up next, the billionaire next door. They may not be as famous as Elon Musk, but there are more of them around than you might suspect. They may not be as famous as Elon Musk, but there are more of them around than you might suspect.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Bringing you up to them in the news whenever and wherever it happens. I'm Sherian in Seoul, and this is Bloomberg. Bringing you up to them in the news whenever and wherever it happens. I'm Sherian
About 80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, But when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank, through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need,
There's going to be now tons of tariff headlines until midterm elections.
hear it first on Bloomberg.
This is a story about your next door neighbor. They may not look ultra wealthy, like a Jeff Bezos or a Kim Kardashian, but sometimes behind that unassuming front door lives someone who's found the secret to attaining great wealth. Princeton economist Owen Zidar calls them everywhere millionaires. Our colleague Scarlett Fu had the opportunity to sit down with both an everywhere billionaire and a couple that aspires to be.
You are one of the wealthiest people in America, but you keep a fairly low profile. I know that you are a known entity in Houston, but outside of Houston, there may not be a lot of people who know who Rich Kinder is.
And that's just fine.
Is that by design?
That's just fine, yeah. I wouldn't say it's by design, but yes, I guess it is in retrospect.
Rich Kinder didn't make his billions climbing the corporate ladder. Instead, Kinder created the bulk of his wealth by buying boring yet essential assets and then scaling them into what is now one of the largest pipeline companies in North America, Kinder Morgan.
I like unglamorous businesses, so it never bothered me in the least to be in an unglamorous business.
Kinder is part of a cohort of high net worth yet unassuming individuals that economists call the everywhere millionaires, or in his case, billionaires.
Wealthy people don't answer surveys, and some of them are covered by the media, but that's only a small slice of what's truly there. There's basically a hidden world of everywhere millionaires.
Owen Zidar is an economics professor at Princeton University who served on the Council of Economic Advisors during the as it pertains to high net worth individuals. His research will be published in a book titled The Everywhere Millionaire later this year.
An everywhere millionaire is a private business owner who is wildly successful, but usually operates under the radar based on the place or the industry that he or she is operating in. So you should think of a local auto dealer who has a big vacation home and like a really nice boat. And there are a ton of them, and they're in basically every neighborhood in America. So the way we measure wealth is the two components. We look at assets, and so the way we measure wealth, and so there are five main types of assets. There's pension wealth, private business wealth, public business wealth, fixed income, and housing. And so we basically add this all up for different projects. Then on the debt side, most debt is housing debt. There's some student loans and car payments, that sort of thing. And what we do is we just take the difference at market values, and that's your net worth.
According to Zidar's research, top earners derive most of their wealth from equity in businesses they founded or invested in.
If you take dentists have more revenue than the total revenue of every professional sports team in America. So the NFL, the NBA, MLB, all of their revenue combined is smaller than the revenue dentists make.
Manufacturing drives almost half of all corporate profits, but it makes up just a small share of the income going to millionaire-owned private businesses. Instead, these owners cluster in sectors like professional services, construction, and finance. What results is a quieter kind of wealth, earned through ownership stakes in privately held firms rather than big publicly traded companies.
Most people think you have to be like Jamie Dimon or Elon Musk, these really famous public company CEOs, to be really rich. But when you look in the data, there are 1,000 private business owners who have at least $10 million in net worth for every public company CEO. You don't have to follow the traditional white-collar path.
Kinder is one of those individuals. After studying law and serving in the JAG Corps, he transitioned to the private sector. He was general counsel of a small energy company that, through a series of mergers, later became Enron. He eventually headed up operations there, which consisted mainly of pipelines. After leaving Enron, Kinder decided to double down on that expertise.
You bought pipeline assets from Enron. And that at that time, the company treated it as kind of unwanted relics of the old economy. What did you see in the pipelines that perhaps others didn't?
Well, I saw that there was an opportunity to take midstream assets, and if you ran them correctly and really watched the bottom line carefully, had a good mix of debt and equity, that you could build those pipelines in a way that would allow your stock price to grow, and then you could use that stock price to make acquisitions of other companies. And that was really our game plan. Yeah, we started with really a tiny company. We had market cap of the company, the value on the stock exchange, about $150 million, and we had about $150 million of debt. So overall, the enterprise value of what we started with was just a little north of $300 million, and we had 175 employees. We had this idea that we would look for assets, we would run them as efficiently as we could, we would bend over backward to serve our customers, and we would provide a good return to our shareholders. And that's kind of the mantra that we've followed for almost 30 years now.
And you built it through acquisitions.
Built it through acquisitions and also just some build out ourselves. Today, for example, we spend about between $3 and $3.5 billion a year on building new pipelines. The trick is don't overpay, but do what's fair and right to produce an adequate return for your shareholders.
Sounds like a very predictable business then.
I think it is. It's, no business without risk. And the old saying that it's the unexpected that always gets you. Who could have anticipated what we're going through in the Middle East today? Who could have anticipated COVID? But if your business is built on a solid foundation, you can weather whatever storms come along. We are partnering to develop a pediatric cancer center that's going to be a new 22-story building.
Rich Kinder made it into the ranks of the everywhere millionaires and beyond. But what about the rest of us? What are the chances we could join him?
This was the, I think, second or third place that we saw.
That's the plan for folks like Ray and Dana Cherry. The husband and wife team left their corporate jobs a couple of years ago,
Popular for general hand washing.
to buy a rather unassuming business in the San Francisco Bay Area, Monsam Portable Sinks.
We assessed hundreds of businesses in this process, and when it came down to which ones we were going to buy, it was a very short list, maybe 4 or 5. And for us, the focus was on the profitability of the company, that it had consistent profitability, that the business itself was near to where we live, and that the product or the service that it was offering was something that was unique and that we felt like we could come into and learn quickly and move to the next level.
This is a business that was founded by a husband and wife team to solve food and beverage service problems. They were selling funnel cakes to local festivals and fairs, and husband, being an engineer, decided to build a unit like this in their garage to help them pass their health inspection. 28 years later now, that couple's retired, and this business has since solved these types of problems for over 11,000 unique customers. And all of that just really excited us.
I'm wondering what led you to leave these corporate jobs, these safe and steady corporate jobs, and decide to become owner-operators. It's a pretty big leap.
We had really successful, long-standing careers in the corporate world. I was in finance, Dana was in marketing. Entrepreneurship was always a really big goal of ours, and we considered different startup ideas over the years. We'd always thought, hey, wouldn't this be really cool if we can do something like this together? And we came across entrepreneurship through acquisition. We thought this was a great time for us to take a shot at ownership, some autonomy, and leveraging our own expertise to building a business on our own.
This felt like a risk-adjusted path into entrepreneurship. The opportunity to purchase a business where there was already product market fit, that was already established and had a path to having us come in and take it to the next level made perfect sense.
We spoke with an economist, an insider, and he says that a lot of American wealth is built through private and what he calls boring, often overlooked businesses. Does that idea feel true to your life experience right now?
Absolutely. As we dug into this, we start to see which types of businesses are really running businesses in this country. That became really clear to us.
We're stepping into a world where there's a wave of small businesses that as those owners retire.
Basically, I think you better understand that you're lucky and you better understand what's going on. if it's a business you understand and can run the numbers on and understand the strategic concept involved, I think you generally do okay. It's when you wade off into something that you don't really understand and you're relying on someone else to tell you, well, yeah, this is something that will really go, just stick with me. That's when you have to be, I think, very, very careful.
What's your advice to someone who wants to build real wealth through their own company, but doing so without the attendant celebrity and white hot spotlight?
I would say just pay attention to what you're doing and don't get carried away with PR or trying to be something you're not.
How would you advise someone who has a real business idea but is perhaps afraid to walk away from a stable career to go pursue it?
Well, I think it just depends on your tolerance for risk. I don't think you want to jump out of a plane without a parachute. So I think you want to have a good understanding of that business that you're starting. In my case, that worked out very well because I knew that the small set of assets we had, I knew that the vector was good. First analyst call we had, spending money, there were so few people covering, so we just had to look at mine. So the 4 analysts, all of whom I knew from my interview, and so one I want to ask, I said, don't you know you? COO of this big company, and now you're starting this little company you're starting now. What do you expect to accomplish? I said, well, I hope in 4 or 5 years this will be $1 billion company. And one of those 4 people I could hear went, ha ha. I confronted all 4 of those people years later, and they all swore they didn't do it. But I know for sure one of them thought I was absolutely nuts.
That does it for us here at Wall Street Week. I'm David Weston. See you next week for more stories of capitalism.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling the deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Peru is maybe first country inspired to me to how can I use the different ingredients. First time I went to Peru, trying to culture food. I never had these ingredients never used in Japan. Kind of like wow, and cilantros, chili, garlic, and olive oils. It's a lot of good seafoods, completely different way. Example, they have the fresh fish, but Japan, the fresh fish uses sashimi. But Peru use fresh fish, like called the ceviche, cooked with the lemon juice. You never use the soy sauce. First time I eat this, kind of wow. So then after this one, my open eye more, my cooking style that change, combined to Japanese style and another country food, then make novel style.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Chevryan in Tokyo.
And I'm Heidi Stradwatts here in Sydney where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything. This is the Asia Trade. I'm Shevrian in Tokyo.
I'm Heidi Stradwatts in Sydney. The top stories this hour. Asian stocks are set to advance while oil gains as traders assess stalled Iran peace talks and a massive week for earnings and central banks. Bets on Fed rate cuts this year getting a boost as a path is cleared for Kevin Warsh's nomination as chair. A 31-year-old man is to face court on Monday after the White House Correspondents' Dinner shooting. He was said to be targeting Trump administration officials, although an exact motive remains unclear. And we speak live to the South Korean Trade Minister, Yohan Koo, about the AI-fueled export boom and the Iran war's impact on supply chains.
And Heidi, you said it's a busy week of central bank decisions around the world. And of course, we have big tech earnings to contend with as well. Already, we're seeing record highs for global markets. And you can see U.S. futures at the moment not doing much, but after closing near record highs, we're already headed for the best month since 2020. And of course, we have big tech earnings. Investors have been snapping up these calls on tech companies ahead of earnings results. Sentiment shifting toward a little bit more of a risk-on tone ahead of those results. And we are expecting the FOMC not necessarily to do anything, given, of course, that we're still contending with the latest headlines from the Iran war, the oil shock as well. Same story for the Bank of Japan and other big central bank decisions this week. We are seeing Nikkei futures at the moment under a little bit of pressure. This after we saw another week of gains already for equity markets in Japan. And remember, what we're watching today will be the Japanese yen, very close to that 160 against the US dollar. And remember what happened just 2 years ago in the same month of April when the Bank of Japan actually did not move and did not hike rates. We saw the yen topping 160 and authorities having to come in to intervene. Also, do watch out for industrial profits out of China. Today, we also have big earnings for Chinese companies this week, including the likes of Geely and BYD as well, Heidi.
Busy week, and of course, as you say, Sherry, we're still contending with a complete lack of certainty as to how or when this conflict between the US and Iran and Israel might wrap up. But take a look at what we're watching when it comes to oil. As you said it, we don't really have further details or progress over the weekend. Of course, we've had other sort of headlines dominating. We know that this round of talks and a trip potentially by President Trump is now put on hold for now. At the moment, this is the picture when it comes to trading in New York. Crude, we're seeing WTI higher by close to 2%, really holding onto those gains. The efforts to resume these peace talks stalling. The ceasefire is still holding, of course, but that chokehold when it comes to the key Strait of Hormuz waterway, with the blockade still in place, we're now entering a third month of disruptions. We know that the International Energy Agency now saying that this is the biggest energy supply shock in history as a result of this conflict. Taking a look at some of the other assets that we're watching, gold at the moment, we're seeing a bit of downside, about 0.6%. Really, the coming back to what we're seeing when it comes to the losses in gold that have really been incurred since the start of this conflict. And we're also watching the Australian stocks. Just to mention, it is a public holiday in some parts of Australia today on account of Anzac Day, but the ASX remains trading. We're looking like a pretty flat start coming off the back of 4 sessions of losses for Aussie stocks, Sherry.
And Heidi, we're also following the latest on the breaking news development over the weekend. A 31-year-old man set to be arraigned Monday over Saturday night's shooting at the White House Correspondents' Dinner in Washington. The acting attorney general saying that the suspect was probably targeting Trump administration officials, but his exact motive is not yet clear. The president told 60 Minutes why there appeared to be a delay getting him and the First Lady to safety.
Well, what happened is it was a little bit me. I wanted to see what was happening, and I wasn't making it that easy for him. I wanted to see what was going on. And by that time, we started to realize maybe it was a bad problem, different kind of a problem, bad one, and different than what would be normal noise from a ballroom, which you hear all the time. And I was surrounded by great people, and I probably made them act a little bit more slowly.
Well, in the meantime, peace talks between the US and Iran have stalled after President Trump cancelled a planned trip by his top envoys. Tehran says it won't negotiate as long as it's being threatened.
It's very simple. Look, that whole deal is not complicated. Iran cannot have a nuclear weapon. It's very simple.
The ceasefire remaining? Do you continue the ceasefire?
Haven't even thought about it.
Did they offer anything in return to 20 years of suspending enriched uranium?
They offered a lot,
What
but
did they offer?
they offered a lot, but not enough.
Let's bring up politics editor Laura Davison for more. Laura, we know really other events over the weekend have sort of overtaken the spotlight when it comes to these impending talks. We know that the Vice President is not headed for this next round of talks, at least for now. Does it feel like momentum is being lost? Where is the pressure that we keep talking about, particularly when it comes to the pressure on the president?
Yeah, so right now there isn't quite the same pressure that we've seen. Trump declined to give another sort of intermediary deadline, like he's done in rounds past. If he set, a deadline from a couple days to a couple weeks for some sort of deal to be made, he didn't have much success with that. And so what we saw last week is him just saying he would extend the deadline sort of indefinitely, and he was waiting on Iran, essentially putting the pressure on them to have a proposal. There's been a game really of will they, won't they, both from the Iranian side and the U.S. side, about sending mediators to Pakistan to talk. We did see Iran send an official over the weekend, but it was unclear whether he was there to actually meet with U.S. officials. He framed it more as a, sort of a tour of the region, meeting with Pakistani officials as well as other Gulf leaders. As he toured around, the U.S. Didn't send anyone. Trump said he canceled the trip from J.D. Vance and other top envoys, Steve Witkoff and Jared Kushner, and going. And right now, we're seeing the president, of course, distracted by events over the weekend. Really focusing on the attack at the White House Correspondents' Dinner and the security situation therein. So this is really a situation where you see the White House almost catapulting from crisis to crisis. And while the White House is a big operation, lots of people who focus on lots of different issues. This, of course, there's only so much capacity for the president to absorb so many things and be in so many places and focus on so many things at once. So this is kind of adding another layer of complication, particularly when it comes to sending U.S. officials overseas when there's already concerns about security of U.S. officials within the borders of the U.S.
And how big of a complication is it that Israel-Hezbollah tensions seem to be escalating again?
This is, again, sort of another, it's a symptom of the broader, disarray here. Having the Hezbollah Lebanon ceasefire in place is sort of seen as a key to have these broader discussions move forward. And with this seemingly fraying over the weekend and over the past several days, this is a sign that this broader piece of the puzzle can't be brought together as well. This of course also raises concerns, just as there's a bunch of different pieces that are also on the president's plate as well. We see he's supposed to be traveling to China here in the next 2 weeks to meet with President Xi. That initial trip was canceled because of the war. So we're just seeing a lot of things pile up, and this puzzle get more complicated, not less, as we drag into the 2-month anniversary of this war set to hit tomorrow.
Laura, you mentioned, of course, the shooting that we're also covering as well. Can you tell us the latest about that? And I guess there are a number of really extraordinary developments when it comes to how this played out. Are there concerns about security at this point?
Yes, after any of these events, like we saw, during the presidential campaign when there was assassination attempt on President Trump's life in Butler, Pennsylvania, there's a wholesale review at the U.S. Secret Service about what went wrong and how to prevent this in the future. But this was, really concerning. This is a big, one of the largest annual events in D.C., a ballroom with thousands of people. And the attacker was able to blow past an initial checkpoint, was not able to make his way into the ballroom, but was able to get closer than a lot of people really felt was comfortable, and before he was tackled and arrested and detained. This is a 31-year-old man from California. There are some initial charges related to firearm, procurement that have been charged. There expect to be more and a formal arraignment in Washington on Monday. But this has really rattled both the White House, the press corps in D.C., as well as raising a lot of questions about a Secret Service that has been, under fire and gone through several leaders here in recent years as there have been a series of security breaches, particularly involving the President Trump.
Bloomberg Politics editor Laura Davison with the latest. Coming up on the Age of Trade, we speak to the South Korean Trade Minister about threats to their AI-fueled export boom after the Iran war and the threat of high energy prices. Much more ahead. This is Bloomberg.
Bringing you up to the minute geopolitical news whenever and wherever it's happening. I'm Anne Marie Verdun in Caracas, Venezuela, and this is Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Trading day is about to start.
You're already looking for that edge.
The opening trade brings you everything you need to know as markets open across the
Let's
field.
talk about significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, just have the risk weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed, only on Bloomberg.
Wednesday, the Fed decides.
Regime change at the Fed. It's a matter of when and not if.
This is not a small matter.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
A series of shocks have interrupted progress.
We've completely priced out a rate cut for 2026. This is a really tough time for all of us in markets.
There is nothing this institution can do in the face of a shock elsewhere.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
U.S. Senator Tom Tillis says he is dropping his opposition to Kevin Walsh's nomination as the next Federal Reserve Chair. Tillis says the Justice Department's decision to end a criminal investigation into Fed Chair Jerome Powell removes a threat to the central bank's independence. The move sets the stage for a faster confirmation of Walsh to succeed Powell, whose term ends on May 15th.
I am prepared, and with the assurances from the Department of Justice that the case is completely and fully settled, that the appeal would only be used to potentially abrogate or change the ruling for administrative purposes, not as a basis for reopening the investigation, and that the only way an investigation would be opened would be a criminal referral from one of the most respected inspector generals there. I am prepared to move on with the confirmation of Mr. Walsh. I think he's going to be a great Fed chair.
The Fed is among major central banks delivering policy decisions this week and is expected to join the Bank of Japan, the ECB, and the Bank of England in holding rates steady. Policymakers are keeping a hawkish eye on fallout from the Iran war as higher energy prices and inflation risks dominate the outlook, and President Trump canceled planned peace talks with Iran. Take a look at how we're looking across markets early in the Asia session because, of course, we have the S&P 500 very close to record highs. A little bit of pressure in the future session early Monday morning, but global equities enter the week around record highs already. The S&P 500, in fact, is up about 10% since the end of March. We're headed for the best month since late 2020. And, of course, remember, we have big tech earnings this week. The dollar a little bit firmer early in the Asian session, Heidi.
Well, S&P Global Vice Chairman Daniel Yergin has warned that the Strait of Hormuz crisis represents the biggest energy disruption ever seen. Yergin told us that the impact extends far beyond oil, affecting assets including fertilizer, helium, and aluminium.
One of the things that people didn't think about before this happened, if they thought about the Strait of Hormuz, they thought about oil. Maybe they thought about natural gas and LNG. They didn't think about fertilizer. They didn't think about helium. They didn't think about aluminum. They didn't think about petrochemicals. And it turned out that that region is much more integrated into the global economy because of all the economic development there. So it produces, about 30-40% of the world's helium, which you need to make semiconductors or MRI machines. So this is actually, unlike all the other things we've talked about in the last 20 years, this is a much bigger disruption to the global economy. But it's Asia, because basically, economically, the Strait of Hormuz went east. 80% of the oil, 90% of the LNG went to Asia, and that's where the shortfall is, in ways that people really didn't want.
I saw Fatih of the International Energy Agency saying we were facing the biggest energy security threat in history. And I wonder if you agree with that assessment at the moment that we're. I'm very curious what Dan Yergin's perspective is on this moment in the wider street.
Yeah, I think this is the biggest energy disruption we've ever seen. But as you say, it's ironic that we're not seeing the full price impact, and so time is really the key factor here.
When you look at this, is it so bad because geographically there's just really no alternative, as there have been some other conflicts? There, obviously there are pipelines that go out to the Red Sea, but you just can't get that volume through anywhere else. And as we've also been talking about, how concerned are you that this could be a chronic problem? Just because Iran agrees to something in the room doesn't mean they're going to change their minds if they've shown they have the capacity to shut this down.
Yeah, there was, until this happened, there was a thing called the TSS, the Traffic Separator System, where people understood that, okay, in an orderly way, this goes this way, this goes this way. Now there's going to be uncertainty over it, and it raises questions not only about the strait, but it raises the question about the freedom of seas on which the water field and world trade really depends. So I think we come out of this, there's going to be an uneasiness about it. And so much will be critical to what the outcome will be. Will there be an actual system of understanding of how this operates, or is it something that will fluctuate?
S&P Global Vice Chairman Daniel Yergin speaking to Bloomberg's David Gura and Christina Rufin. Let's discuss the markets now with Bloomberg and Live strategist Mark Cranfield, who joins us with the latest. And Mark, of course, we have listened to that conversation about the uncertainty around the Strait of Hormuz, what happens to oil prices as well. Given the week of central bank decisions, is it really not that surprising that we're not expecting any big moves?
I wouldn't say we're not expecting any big moves. When you start the week with oil prices back above $100, and you've got a slew of earnings from the major tech companies as well, plus you really don't know how the central bank is going to interpret the whole thing at the shortfall between energy prices in the near term and yet slowdown of economies in the longer term. There's plenty that can happen. I don't think we were in for a quiet week at all. And then, of course, you can always throw in the occasional headline that comes out from the US as well. So quiet, no. I don't think there's any chance of that this week.
No, to be fair, I was talking about no big moves from central banks. I mean, we are expecting those gyrations in the market, right? I'm in Japan, so I'm very much watching the Japanese yen. How closely are you watching the bond space as well? Because it's been interesting, the volatility hasn't necessarily been that pronounced in the rate space.
I think that's where, if you're going to get surprises from the central banks, it would be what they do to the market curves in terms of yields. Generally, there's been a bit of flattening in bond curves in the G10 space, and that certainly is, people go into this, they don't expect too much disruption in that, but certainly with so many central bankers and with so many things up in the air, you definitely got the chance for some surprises here, particularly from the European Central Bank. They come into it with quite a split in between. There's a very big committee, more than 20 people on it. There's lots of varying decisions about whether they need to preempt, whether they need to raise interest rates early, or whether they need to delay it, and they need more information about what the energy price impact is going to be. So certainly there is room, particularly with the press conference from Christine Lagarde, there's room for plenty of volatility around the ECB meeting. Even the Bank of Japan, Governor Ueda is probably feeling a little bit disappointed that he's had to push back and not raise interest rates this week, but he wants to prepare the market to get the neutral rate in place for Japan before too long. So he may well push pretty hard to get expectations up for the June meeting, if not for July. So certainly whatever he has to say in his press conference could also cause a bit of volatility in the JGB market, and maybe even for the dollar yen as well. So what central bankers have to say in terms of their outlook, how they gauge the effects of energy prices and potential slowdowns in economies, consumers pulling back in the months ahead, that is the place where bond traders especially will be looking for any disruptions there, chances for them to make trades, whether the curve steepening is justified or whether they need to make changes to that.
Mark, we've seen some of the big tech companies that comprise about a quarter of the market cap of the S&P 500, and certainly the biggest drivers of this record rally that we continue to see. How much these companies, the likes of Meta, Amazon, Alphabet, really need to not just meet expectations, but perhaps over-deliver on expectations to try and counterweigh the negativity over the war and oil prices?
That's what we've seen consistently over the past sets of earnings, whether it's from American companies or from Asian companies. It's all about the outlook. It's all about justifying to investors that these huge amounts of money which are going into AI data centers, into the whole build out of AI, whether it is justified in terms of what they see in the pipeline ahead. If the big tech companies in America can make investors continue to believe that there is even better times to come, that the profitability coming out of AI products is going to be just as good or even better than what they've seen so far, then investors will be in a very good mood. The equity rally will continue. It's a very high bar, and we've seen how quickly companies can get punished. You can just look at the difference between, say, a company like Intel satisfied investors very well, the stock goes up very high. Then you look at the big Dutch company ASML, they were disappointing, the stock goes down quickly as well. So it's a very binary situation. Investors are not going to waste their time for too long. If companies don't justify what they're doing, stocks are going to go down pretty hard, but there's potential for a very good upside if they do meet where the market is pricing for them in the future. So forward earnings are suggesting that they can continue to do so, but they need to justify it in how they position themselves. It's a very big week from that point of view, and it will make the difference between whether equity markets go into May on a very solid footing or whether they don't. It's really up to those big four tech companies.
Bloomberg and live strategist Mark Ryan for kicking off a busy week, big tech, but of course also the busiest week when it comes to earnings here in Asia as well. More ahead on the Asia Trade. This is Bloomberg.
About 80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, but when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
The president of Chinese carmaker NIO says the country's auto market will stabilize this year, with electric vehicles continuing to gain share despite a weak first quarter. Li Hongqin told us explicitly that the company remains committed to pure EVs and is targeting full-year profitability in 2026.
Looking at China's auto market consumption this year, specifically in the first quarter compared to the same period last year, retail sales figures for the entire market declined nearly 18%. This was due to a variety of reasons, including changes in the tax system, changes in electric vehicle subsidy policies, and intense competition. Manufacturers likely made a sales push at the end of last year, releasing some pent-up consumer demand. However, we still believe that the overall market size in China will remain at a similar level to last year, meaning that the next 9 months will see a significant increase compared to the same period last year. Another point is for companies like ours that manufacture electric vehicles. The electric vehicle category is still growing. Although the overall market pressure is relatively high, the trend of pure electric vehicles replacing other energy forms, especially gasoline vehicles, remains unchanged. We predict that in 3 to 5 years, more than 80% of new cars in China will be new energy vehicles, and 80% of those will be pure electric. Currently, there are probably only 2 companies worldwide still adhering to the pure electric route, NIO in China and an innovation company in the US. We think we will firmly uphold our choice and wait for this market window to open.
When are you going to be full year profitable? Going to be this year?
This year presents significant challenges. As you can see, starting in January due to various reasons, raw material prices have risen very rapidly. This presents us with new challenges, but our goal and determination to achieve profitability for the entire year of 2026 remains unchanged.
Any plans for a battery swapping division IPO?
Currently, we don't have an IPO on the agenda. Our battery swapping service remains a service department within NIO. We hope they can set aside short-term financial pressures and focus on serving our 1 million car owners.
NIO co-founder and President Li Hongqin speaking exclusively to Bloomberg Stephen Engel at the Beijing Auto Show. We, in fact, will be watching some more earnings out of China, including BYD and Geely as well. They are also expected to benefit from higher oil prices, boosting EV demand. More ahead on the Asia trade. This is Bloomberg.
When U.S. jobs numbers are released, Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with the close. Weekdays on Bloomberg. Context changes everything.
Welcome to Bloomberg This Weekend. I'm David Burrow.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling the deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We've got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Five of the so-called Magnificent Seven U.S. tech giants are set to report this week, with analysts expecting robust revenue gains as they continue to capitalize on AI investments. But Alphabet, Amazon, Meta, and Microsoft facing rising margin and cost pressures made worse by the war in Iran. Apple continues to grapple with higher memory chip prices and the risk of prolonged supply chain disruptions. We're also keeping a close eye on tech here in Asia. Massive gains from TSMC, Samsung, and SK Hynix have helped elevate Taiwan and South Korea in global equity rankings. This chart also showing tech-heavy Asian markets muscling past their European counterparts. For more, let's bring in our Asia equities reporter, Sang-Mi Cha. Sang-Mi, we have just mentioned some of the challenges that U.S. tech companies face, but across Asia, we're seeing valuations lower, perhaps a bit more appetite for investors to come in and continue this AI surge higher?
That's right, Sherry. We're seeing about $4.3 trillion of market cap for Taiwan, and it has surpassed that of the UK just earlier this month. And South Korea is about to do the same, just away 140 billion, in fact, to catch up the UK. And UK being like the biggest market cap in across Europe, and it's done the same for Germany and France. So these two North Asian countries are really taking over the European equity market one by one. And we're seeing this because it really trickles down to these three companies, right? TSMC, the logic chip maker in Taiwan, Samsung and SK Hynix in South Korea behind these AI chips. And it's actually, you can see those data in the export shipments, right? So in Taiwan, we have seen the exports in March rally the most in the fastest pace in 16 years. And for South Korea, it's been rising 40% for the two months in consecutive months we have seen. So we see these data. It's really, you can see that they're exporting these chips across the world, and these are leading to this unstoppable rally in equity markets.
Is it time to get a little bit cautious about just how much influence these tech stocks have in Asia?
There are these concerns. See, and so investors are noting that there are these weightings, right? SK Hynix and Samsung make up about 40% together in KOSPI index. And for TAIEX, it's the same. For TSMC is, again, taking up almost half of the entire benchmark. So that does point to that concentration risk. But in fact, when you look at TAIEX, the Taiwan benchmark, the TSMC weighting has been coming down a little bit because it's been trickling down, through other supply chains like Delta Electronics and MediaTek. So investors are saying that as the AI integration becomes more advanced and people actually need more of the supply chain, not just the chips or the memory chips and the logic chips that we talked about, it will continue to broaden out. And so the concentration risk is not so much of a problem right now.
Our Asia Equities reporter Sang Mi Chao there. Let's get you the latest when it comes to some of these corporate headlines this hour. And a social media account affiliated with Chinese state media says DeepSeek's delayed release of its V4 model points to a shift towards deeper integration with China's chip ecosystem. The startup on Friday released preview versions of its long-awaited new model, but analysts have told Bloomberg that it fails to narrow the gap with leading US products. The account says DeepSeek spent months working to optimize performance using Huawei chips. Watching Nomura shares at the Tokyo Open after it posted a second straight year of record profit fueled by Japan's market rebound, even as fourth quarter earnings missed estimates. Net income of Japan's biggest brokerage rose nearly 3% from a year earlier. Nomura had benefited from volatile global markets and a boom in investing and deal making at home.
With regards to the situation in the Middle East, if the supply chain changes significantly, then we will have to implement a structural change in strategy, and this could affect M&A activity in the long term. But as of now, we're not envisioning such a scenario.
More ahead here on the Asia Trade. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We're about 20 minutes away from the open of markets across Japan. And take a look at how we're setting up. A little bit of upside for Nikkei futures. This after we saw already 3 weeks of gains for Japanese equities. The yen weakness continues, headed towards that 160 level and weakening early in the Asia session already. The Bank of Japan, of course, is a big news this week. It's expected to hold at that 0.75% rate. It struck a hawkish tone back in March after the oil spike, but right now markets pricing in almost virtually no rate hike at this point. Bloomberg Economics expects a hike in June. Let's get more on the outlook for the BOJ with our economy and government reporter Erika Yokoyama, who joins me here in the Tokyo studio. So we were at markets pricing in more than 70% of a rate hike just a few weeks ago to virtually nothing. What's going on?
Yeah, right. So we successfully communicated and these expectations for the rate hike in April. And, as you said, tomorrow we are expecting the rate stand-pat decision at 0.75%. And probably the bank will heighten uncertainty over the Middle East for a reason. And the likely decision, as you said, is already largely priced in by the market. So the real focus
is when the next rate hike will be. Is it going to be June, July, or it can be later? We could possibly see the message through either the policy statement, especially on the section of the voting balance of the 9 board members, or simply like Governor Ueda's press conferences as well. And another thing we have to watch tomorrow is that the bank is expected to raise inflation outlook for the current fiscal year significantly, reflecting the recent surge in oil prices, right? So if the upward revision is larger than expected, it's kind of like a signal that the rate hike in the near term is sort of needed to address the situation.
But remember what happened 2 years ago, exactly in April, when the Bank of Japan did not hike rates and we saw the yen just topping 160. Given that, as we have said, markets have largely priced in no move, does that mean, well, I don't want to say we can expect stability in the yen at this point, but are we less scared of a horrible move that could really derail markets?
Well, like even if the decision was already priced in by the market, on the BOJ day, we have a higher risk of market action by the government. Because, for example, back in January, the BOJ kept the interest rate unchanged and the yen weakened. Then US and Japan coordinated and did the rate check, basically linking up the banks to check whether current exchange rate is appropriate. Then that action itself, moved the yen as well. And also back in 2024 spring, and that's the time the government actually did intervention after the yen weakened past 160 for the dollar. And, and especially this time, Japan is entering the Golden Week holiday. The trading will be thinner, then liquidity will be much lower. So that there's an incentive for the government to step in now.
And you and I spoke to the finance minister last week, and she was talking about all of the speculation in the markets, right? Mm-hmm. So what should we be watching out for in terms of sort of signaling that we can get from Governor Ueda at the press conference about when the next rate hike happens?
Yeah, there are a couple things, but first things probably like whether Ueda will update the assessment of risks stemming from the Middle East. So far, Ueda and the other bank officials have been saying there are both sides of risks, upside and downside to prices. But majority of market economists are seeing inflation risks skewing to upside. So traders should be watching whether Ueda will agree with this view. And another thing is that Ueda probably shouldn't be overemphasized the uncertain aspect because it's easily associated with the situation. Last year around this time when the Trump-related uncertainty just caused the BOJ to suspend the rate hike.
The sweeping tariffs, basically.
Yeah, exactly. So we don't want, if the BOJ don't want to, see the repeat of that, probably the BOJ need to clearly tell that the bank is on track for the rate hike as soon as the outlook is materialized.
It will be a very tricky communication exercise for the BOJ. Erika Yokoyama here in Tokyo. She's our economy and government reporter, of course, with what to expect from the Bank of Japan. In fact, our next guest also says the odds of a rate hike on Tuesday from the BOJ are near zero. Joining us now is Shrikant Keli, Senior Quantitative Strategist at Jefferies. Shrikant, really good to have you with us. So will this be more of a messaging exercise when it comes to the decision on Tuesday?
Well, absolutely. Tomorrow's day, an event with multiple implications across different classes, as you already mentioned. The odds of rate hike tomorrow almost are close to 0%. So it's not an event which doesn't mean from a policy perspective, but it's an event which can give you a lot of signals in terms of what BOJ Governor Ueda is thinking about in terms of the next rate hike. For me, what matters is, are all the preconditions that are important for rate hike still in place or not? If you look at the recent inflation data, the core CPI Japan still remains above 2%. If you look at the recent inflation series published by BOJ last month, also continues to remain above 2%. And on the back of geopolitics, on the back of oil prices, we know the inflationary pressure is only going to rise going forward. If you look at the recent wage change, the nominal wage gains, the base level data increased by 3.3%, which is highest of the past 33 years. Now, I understand BOJ's mandate is not yet, but at 160 level, we all understand it can induce cost-push inflation. So all the preconditions that are necessary for rate hike do exist. The only fly in the ointment is the geopolitical uncertainty. So I would expect Ueda to wait out to have the resolution. Yes.
But the fundamentals, as you said, are there, right? So how much of this is also political in the sense that this government specifically, doesn't want to see rate hikes too soon? And if that's the case and markets perceive it as the central bank lacking independence, could we see that instability that we've seen in the long end of JGBs?
To be honest, of course, there is a political aspect as far as the bond yields are concerned. But we have to also understand that Japan is eventually a warrant on global growth. The conflict that we are seeing right now, most of the Asian markets, including Japan, have strategic reserves. So we haven't yet seen the impact on the demand side of the equation, Sherry. So if this conflict continues and the Strait of Hormuz remains closed, because of which global growth comes under pressure, you have to understand that Japan is a massive warrant on global growth. On top of that, Japan's operating leverage is highest in the world, which means the impact on Japan's operating profit going to be extremely high. So in light of that, I think it makes sense to me for BOJ to wait out tomorrow. As soon as we have the resolution on this conflict, that's the perfect time for BOJ to increase rates. Although BOJ's mandate is not growth, at the same time it can have implications on Japanese inflation.
We have uncertainty as to whether or when this conflict is going to come to any kind of resolution. But if you talk about the huge vulnerabilities that you're pointing to when it comes to the Japanese economy, the longer this drags out, do you think this then endangers the virtuous cycle? You touched on the wage data a little bit earlier.
So there are two parts to this story. What we've seen with Japan over the past 3 years has been a massive bottom-up revolution, which was missing for Japan over the past 25, 30 years. We have seen doubling of buybacks to 23 trillion over the past 12 months. Dividends in Japan have risen to almost 27 trillion. Total payouts of Japan have risen to as high as 71% levels. Total yield have risen north of 4%. Cross-holding and money in Japan is accelerating. Activism surging to record high levels. All of these changes in Japan are unprecedented. What was missing over the past 3 years was this stable, pro-growth political leadership. So to that end, I think for the first time, Japan is seeing twin drivers of strong bottom-up revolution, along with pro-growth political leadership, which makes Japan an extremely attractive investment story across the world. Again, my forecast for topics for the year end is 4,000. Japan is already up almost 35%. I'm saying topics from the start of last year. Bulk of those gains have been driven by significant valuation re-rating, which means valuation re-rating driven upside for Japan market going forwards are limited. At the same time, bulk of the upside for Japan going forward will be driven by sustainable delivery of earnings, which is what I expect. My expectation or topics are 14% earnings growth for March 2027. Of course, there are risks. If you're heading towards demand destruction, of course, there are risks to Japan, but that's not my base case. I'm expecting early resolution to this conflict.
You are watching the inventory levels, so right? I understand that's more of a tail risk, but that's something that is worth being aware of.
Oh, absolutely. I think Japan is the only market where inventory as a percentage of sales data is at record high levels. Now, if you look at US and Europe, they're still at kind of average of the historical levels. But in the case of Japan, the significant surge in inventory actually happened on the back of COVID. And it was a sensible response from companies. If you break down the global inventory data of Japan, the early surge of inventory was mainly driven by increase in raw materials, where companies wanted to have a seamless production cycle. That's why they had requisite amount of raw material inventory. But that's not the cause of concern for me. The cause of concern for me.
Go ahead.
The cause of concern is the significant increase in the finished goods inventory, because all these companies, if they're heading towards an environment of global growth slowdown, then these companies with significantly elevated fixed goods inventory would be at risk of inventory write-down, or in worst case, inventory write-down. That's a risk for Japanese markets.
So, Shrikant, before we let you go, following up on my question on the volatility in JGBs that we could potentially expect from this decision, walk us through what you're watching in the JGB space, also in the equity space, because we have had significant optimism in the equities market in Japan, and where the line in the sand is when it comes to the Japanese yen weakness, when authorities could step in.
Oh, that's a long question. So my view on the yen, I'll begin with, which has implications on JGB as well. My view of yen since start of last year is that we have moved from yen being a one-way trade towards becoming a two-way trade. Japanese yen was primarily a function of differential of monetary policies between BOJ and FOMC. That correlation has completely broken down since the middle of last year. Japanese yen has become a function of three things. One is this dovish rate hikes by BOJ, hawkish cuts by FOMC. So the fundamental bias for yen will be towards weakening. But at the same time, we have this fundamental backstop from Ministry of Finance at around 160 to 162 levels. So my base case is yen will remain range bound between 150 to 160 levels. Now, as far as JGBs are concerned, Sherry, I'm not a fixed income strategist, but on the back of what's happening, the expansion of fiscal policies pursued by Takaichi administration, on the back of no backstop from BOJ, no YCC, I'm expecting bond yields in Japan to remain elevated. So what matters to me is the impact of these elevated bond yields on the equity space. Over the past 25 years, during the periods of elevated bond yields, Japan market on average has delivered strong outperformance. Japanese yen has depreciated, and what you want to focus on as far as Japan market is concerned are the the risk-on styles like value, GARP, and yield at the expense of low vol and quality. That's what I'm recommending to my investors on the back of these elevated bond yields.
Great job in putting everything into perspective on the market. Shrikant Kale, really good to have you with us. Thank you. Senior Quantitative Strategist at Jefferies. And of course, you can catch Japan Ahead every Monday, 8:40 a.m. Tokyo time. Subscribers can also watch live on the terminal using the TV Go function. More ahead. This is Bloomberg.
Every weekday, Bloomberg puts a spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Matei. And I'm Christina Raffiti. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Let's get more now on the weekend shooting in Washington, and President Trump has been using the incident to bolster his case for building a massive White House ballroom. Let's get more with our White House correspondent Jeff Mason, who was at the event. And Jeff, of course, you're also a former president of the White House Correspondents Association. Talk us through what you saw and how things played out that evening.
Sure. So as most people know now who've been watching a bit of the news over the last 24 hours, the White House Correspondents' Dinner was taking place in Washington last night when an active shooter was able to briefly breach the security perimeter and exchanged gunfire with a member of law enforcement before he was captured. Inside the ballroom, I was sitting at a table with other guests and Bloomberg reporters, and I heard the shots outside of the ballroom. We then ducked and covered underneath our tables as The vast majority of the ballroom did, and then really just waited for word about what was happening. There was a lot of sort of questions and not a lot of clarity about what was going on as we were waiting as to whether or not there was still an active shooter. There was speculation that proved not to be correct, that there might have been some kind of an explosive. And the Secret Service, of course, was focused on getting the president and the vice president and multiple cabinet officials out of the room. So not necessarily telling the rest of us what was going on or what we needed to do.
How are you expecting this to change the conversation around security, around President Trump? And of course, what are we learning as well about the gunman at this point?
Sure. So the security around any president is always a big deal and a big issue for the Secret Service and for the White House. The president has been painting this as a success story for the Secret Service because they apprehended this man so quickly and before, of course, he actually made it into the ballroom and was able to hurt anyone. As far as broader security questions, one of the questions is whether or not this dinner can happen again. The president said that he'd like to see it happen within the next 30 days, but whether or not that can happen at the same hotel and whether additional security measures will need to be taken, those questions are still being answered. It would seem like the answer, at least to the latter question of whether additional security is necessary, would be yes. As far as the shooter is concerned, he is a 31-year-old male from California, and there's been some reporting about a manifesto that he wrote and released very shortly before starting his attack, and that manifesto apparently suggests that he was targeting President Trump and members of his administration.
White House correspondent Jeff Mason there in DC. Let's take a look at what the hour ahead holds. And of course, we are just about 4 minutes away from the start of cash trading, including here in Australia. It is a Nasdaq Day public holiday for much of the country, but the ASX is trading. We're looking like we're headed for a fifth straight day of losses here when it comes to Australian stocks, not really benefiting much from, of course, the tech-driven rally that we've seen in other parts of Asia and, of course, in the US, driven to those record highs. We will be watching some of the energy names, given that we continue to see those upside moves in oil prices, the Strait of Hormuz shutdown, inaccessibility at the very least, going into a third month now with still a great deal of uncertainty as to when these next peace talks will occur. Nikkei futures, though, looking pretty positive, about 0.5% higher there. We're also seeing coffee futures looking like we'll see a run out of those gates. This is Bloomberg.
We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
No, that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions: software, hardware, chemistry, physics.
The cable's very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to Nasdaq.
It's not just like, let's buy the Mag 7 or AI. That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg 10.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens with global stocks around record highs. It's a big week, Heidi, of central bank decisions around the world, not to mention mega tech earnings as well.
You would not blame major central banks for being sort of paralyzed by the inability to make any strong positions at the moment, right? With the uncertainty over the Strait of Hormuz, oil prices continuing to gain, no progress being made or momentum even when it comes to these peace talks. But at the same time, Sherry, it's a very high bar for some of these tech companies to continue impressing with their forecasts.
And it's really that uncertainty that you mentioned around the Strait of Hormuz, around the war in Iran, that has really changed the tone for the Bank of Japan here, because we have heard more hawkish rhetoric coming from Governor Ueda just last month. For that to be all really turned upside down in the last couple of weeks, of course, growth concerns are now big. We are in an economy that's heavily exposed to Middle Eastern oil. So take a look at how Japanese equities are coming online. You can see a little bit of upside for the Nikkei, a little bit of downside for the topics, a little bit of divergence, as you can see. We're lacking clear direction as we head towards the Bank of Japan policy decision. Just tomorrow, no change expected there. 0.75% expected to be the rate. And as I mentioned, even markets were pricing in more than 70% chance of a move of a rate hike by the Bank of Japan just in March, for that to be virtually zero now this week. So we'll be watching the weakness of the Japanese yen against the US dollar, because remember what happened 2 years ago in April of 2024 when the Bank of Japan failed to hike rates. We actually saw the yen topping 160, authorities having to come in and try to support the currency. Do watch out for JGB's volatility as well. Take a look at how Korea is opening. We mentioned those megatech earnings coming out of the US. Of course, we have tons of suppliers in Asia. We're watching Samsung, we're watching SK Hynix, which of course form about 40% of the Kospi. You can see slight upside early in the session for Korean equities. The Korean won also holding steady at the 1477 level, Heidi.
Take a look, Sherry, as to how we're trading in the first few minutes or so of Australia opening up. We're expecting liquidity to be a little bit thin, given that the likes of New South Wales, for example, off for an Anzac Day public holiday today. But still, we are online. We're looking like potentially we could see that fifth consecutive day of losses for really the tech light market that we have here in Australia. But still, some of those energy names will be in focus, given that we continue to see those gains across oil prices. Brent crude coming online, seeing upside of about 0.2%. Also watching treasuries. It's a big week, as you say, for equity traders, but also for bond traders as well. Central banks are really setting those rates, giving potential reasons to sell off those government bonds, particularly when it comes to treasuries. A great deal of uncertainty as we're still watching for what the next developments on the war will be. Well, joining us now is Jasmine Duan, who's a Senior Asia Investment Strategist at RBC Wealth Management. Jasmine, great to have you with us. So we are now heading into potentially a third month of disruptions when it comes to the Strait of Hormuz. There's now, of course, a lot of commentary around what the primary, but also the secondary and tertiary impact of this energy crisis will be. What are you watching in terms of the major risks to investors?
We think it's very reasonable to assume the negotiations will be back and forth and we will take several rounds, but we still expect a compromise deal can be reached. And the major reason is because both sides wants to end the war, and both sides has laid out their conditions for how peace looks like. And both sides have agreed to a ceasefire. And we think China plays a very important role in bringing Iran back to the negotiation table. So Iran's calculus is more than just how long the regime will last, a prolonged war. And China will be the largest beneficiary if the two parties reach a deal. So we think China will want both sides to have a rapid resolution. And of course, the risks will be to the impact to the economic and to the broader inflation. And we think, in general, risk may be smaller than we currently feared because right now the U.S. inflation risk has come down from the peak. And later this year, if we are seeing a deal is being reached, we may see few months of outright deflation. So inflation at the end of the year is likely to be lower than at the beginning of the year. So full year inflation may be lower than we currently fear.
Some of those reasons would be contributing to why you're still overweight when it comes to US stock. Are you seeing there to be a lot more runway when it comes to these record gains that we see being driven by big tech?
Right now, we are still cautiously optimistic in U.S. equities. Of course, in the short term, the U.S. equities may be a little overbought, but we are seeing some positives, mainly due to two reasons. First is the broad market participation is still positive. If we look at the advanced decline lines for the S&P 500, it's still at record high level. And typically, if not, equity cycles doesn't end if the market participation is at record high. And also, if we look at the tech sector, it contributes to around 50% of the U.S. market cap. And the tech sector is coming up, delivering very solid earnings growth. And counterintuitively, energy crisis or higher energy price is a tailwind for the U.S. corporate earnings because since the start of the war, the S&P 500 earnings estimate has been revised up by 2.3%, and half of that comes from the tech sector and half of that comes from the energy sector. So the earnings growth is still very solid for the U.S. equities. That's why we are still maintaining an overweight position on the U.S. equity market.
How much of that will also be filtered through into the Asian market, given, of course, how many of those tech suppliers are across markets here in Asia?
Yeah, we think investors are trying to look for very solid earnings growth and solid sectors to buy into. And besides from the US AI and tech companies, investors are paying attention to the Asia tech sectors, especially we have a very large amount of suppliers here. So if you look at the earnings estimates by, for example, of the Korea tech companies, the memory chips companies, they are expected to deliver 4 to 5 times earnings growth this year. So the earnings growth is still extremely solid, and that's why we're seeing investors' interest continue to go into these sectors. And for the AI tech companies, also we are seeing some positives coming out. The AI model capability continue to improve, and the valuation is relatively attractive compared to their US peers. So investors may still turn attention to the AI Chinese AI companies.
Do you worry about the concentration of some of these big names like Samsung, TSMC, and their role in terms of their home markets?
Right, to some extent, most of the investors are only looking at the big tech names, and in the short term, we do see some risk of overbought and we may see a period of consolidation in the near term. But overall, it will all come back to the earnings growth. We're seeing the big tech companies deliver very solid earnings, and that's why investors will continue to put their money into these big tech names. So we think the earnings growth will digest the concern on this overcrowded trades and also the short-term overboard in the market.
Outside of tech and AI, how else are you capturing the upside and also obviously mitigating the downside risks of the war as well?
Well, at RBC Wealth Management, we are trying to build a diversified and resilient portfolio so that we can mitigate the risk and capture the upside both from the war and peace scenarios. And that's why right now we are holding both energy, chemicals, and technology stocks. And we are also trying to capture the short-term market volatilities, taking advantage of the market movements to do some short-term tactical trades. And we think in this kind of market environment, investors have to be super nimble and flexible. And that's why we need to be more be more flexible and trade on the focus on some short-term opportunities.
Definitely really great to have you with us, Jasmine Duan, who's the Asia Senior Investment Strategist at RBC Wealth Management. More ahead here on the Asia Trade with Bloomberg.
This is a 15, 16 gram tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a bowl. Put wasabi in the middle. Then my process is up to 6. 1, this is putting the between the rice air. Then make the 4 fingers curl, make sushi shape. Then touch this. 2, then turn. Now these 2 fingers, cup the bottom, make the sushi shape the more beautiful. 3, then I'm not looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is the 1, 2, 6.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
Very good question.
Interesting question. Good question. Great question. I so appreciate that question. Please let me ask interesting questions.
Bloomberg Television. Top experts, great questions.
Korea markets continue to gain early in the Asia session. You're seeing the Kospi now gaining about 1%. The Kosdaq also catching up as tech companies are leading those gains. You can see on the right side right there how South Korea's stock market rally has really surpassed a lot of other global markets. We're talking about the Kospi gaining more than 150% in the past year. Samsung and SK Hynix, of course, driving that AI boom, making up about 40% of the Kospi. And these Asian markets, in fact, muscling past European markets. Of course, they're more heavily focused on tech and those AI suppliers. Our next guest is at the center of a pivotal moment for South Korea's economy, as that AI-driven export boom is also tested by rising protectionism, energy supply disruptions, and of course the need to diversify markets and supply chains. Young Gu is South Korea's trade minister and joins me now from Singapore. Minister, it's always good to talk to you. Thank you very much for your time.
Thanks for having me.
I wanted to start asking you about this immense optimism and solid trade numbers, export numbers that we're seeing from South Korea. How much of that story do you expect to be derailed by the ongoing war in Iran?
I think overall, the Korea's export has been really robust. For example, for the last 10 consecutive months, the Korean export has been growing. And the last month, which is the March, our export hit the record level of $68 billion for the first time. I think it's really driven by kind of strong demand for semiconductors around the world. So despite some concern related to all the tariffs and uncertainty in the Middle East, I think the Korean export has been really showing robust performance so far.
Is there a risk that a lot of the materials, naphtha, rubber, resin, a lot of the things that could potentially go into the supply chains, especially around tech exports, will be hit given the ongoing conflict in the Middle East?
Yes, in fact, the supplies of the naphtha and these are being squeezed. So we are taking domestic measures to kind of restrain the export of this naphtha. At the same time, we really make all out efforts to secure more naphtha from the other region than the Middle East. Previously, 80% of our naphtha came from the Middle East. So we are exposed to this kind of potential risk in the region. And now I think diversifying is really a way to go. So now we are making all these efforts to find new alternative sources and partners for this.
Have you gotten any commitments from Asian partners? I know that you've been to India, you've been here in Japan, you're in Singapore right now.
Yes, the last week the Korean president made a state visit to India, and actually the Korea and India signed MOU on this cooperation in energy and this sector. I think all these other countries are also struggling with this shortage of naphtha and other the chemical products, but we are making efforts.
I know that you've had perhaps some concerns coming from Indian authorities as well about the SEPA trade deal and how balanced it is. Will that have any implications to how much cooperation you can get from them?
Yeah, I think we had a really this great agreement last week in India to really accelerate this upgrade negotiation for Korea-India, SEPA. I think we have really this great potential. I mean, our economies are complementary. A lot of Korean businesses in automobile, electronics, and shipbuilding, they have invested in India and they are considering investing in India. So I think upgrading this almost 17-year-old, the framework of trade and investment will actually really boost further trade and investment between our two countries.
And one of the trade deals that we're watching the most is the one between South Korea and the United States, right? Can you give us an update on the implementation of the $350 billion U.S. investment package? Have you chosen your first project? We're hearing that it could be the Louisiana LNG export project.
Not yet, but I think we are on the right track. The last March, Korea's National Assembly passed a special law to operationalize this $250 billion investment fund. So now we are in the process of creating new government agency to execute this investment the project. So now we are in a preparatory mode, exploring what kind of project could be really mutually beneficial. I think what is important to Korea is to really make sure that those projects are commercially viable and mutually beneficial. If that's the case, I think this could be turned into a really new opportunity for many Korean companies to invest and